Let me show you how to make sure that you always have money left over to pay yourself, invest for growth, or save for the future. If you run your own business, you might struggle with cash shortfalls, handling debt, or feel like you aren't providing enough for yourself. Well, in this video, I'm going to show you several ways to analyze your business and make sure that you don't have these problems. I'm Noah, and I'm the founder of York Wealth Management, where I work with solo business owners, solopreneurs, and freelancers to make sure that we build financial plans so that they don't have these issues. Most of these issues come down to a term you're probably familiar with called cash flow. Now, you may think that's just a fancy word for budgeting, and while there is some overlap, here's why cash flow is different. Budgeting is just making sure that you spend less than you earn and track your expenses closely each month. Cash flow isn't less than that, but since businesses have irregular expenses, cash flow tracking often accounts for that and makes sure that business owners have enough money to pay their bills, their employees, and its owner. Each month, a business has inflows and outflows, and if its inflows are greater, it has positive cash flow. And if its outflows are greater, it has negative cash flow. Now, just this information is actually not a good indicator of health for a business. Why? Well, because businesses might receive funds up front or after they've actually done their services. So there might be several months of negative cash flow, either followed by or preceded by a very positive month with a lot of cash flow. This is why it's important to create a cash flow forecast. This is when several months or even a whole year is laid out and given a plan. So as a business's cash flow goes up and down, the owner can still pay their bills and pay themselves. Not only that, but it allows for you to plan for your business to grow. As a business grows, it's going to be faced with problems that are going to cost more money to solve. And knowing how much money is coming and going will allow you to plan around that. Now, there are three categories of cash flow. Cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. As a small business owner, most of your time is going to be spent on the first section. Operating activities include all transactions and events that would happen on a day-to-day basis running your business. Selling goods and services, inventory, payroll, utilities, subscriptions with how much digital space is taken up these days, and rent. All of these would fall under operating activities. Now, these events are actually the easiest to track if you use an accounting software like QuickBooks or even just go to your bank statements. Oftentimes, it will allow you to categorize everything by transaction. But even if it doesn't, these expenses are probably more regular than the other two categories we talked about, so they would be easy to document and to write down. Now, a challenging situation can arise if you run a seasonal business, because you can't just look month to month in order to look at historical data. You have to look even further back than that. So forecasting a seasonal business is quite difficult in the first couple of months, but each month you learn more and more about your business and get better numbers to do your calculations with. Well, many businesses work this way too, even businesses that aren't seasonal by design. Does financial planning strike you as a seasonal business? Well, it is. Many people contact a new financial planner in the first 3 months of the year, partially because of things like tax season, but also because a lot of people feel a drive to get their money in order after the first of the year. So a lot of businesses have to contend with seasonality even if they aren't a seasonal business. So when you're looking at your operating cash flow, there are 3 things you need to look at: your sales projections, your expense estimates, and the timing of both of those things. Now, this is going to look different for every business. Some people might have more consistent sales because they work off of something like a subscription system, while others might have staggered one-time purchases because they do work as a contractor or freelancer. And the same thing applies to expenses. If you're a retail business, you might purchase inventory regularly, or you might have really big staggered purchases throughout the year. But something like a service business might have more regular expenses every month. Like I said before, cash flow from operating activities is the biggest part of a small business's system. But what about the other 2 types? Investing and financing cash flow. Well, both of these would be irregular income and expenses. For example, if you buy a building, land, equipment, or some other asset, that would be cash flow from investing operations. Even if it's not something that will appreciate in value, most likely you're buying it in order to make more money or to make your life easier, to make your business run smoothly. And then cash flow from financing activities would be something like taking out a loan. If you look at your cash flow statements, the month that you actually receive the loan is going to have a very, very high inflow of cash. Another tidbit of information is that financing activities can also apply to issuing stock or bonds. but that doesn't really apply to most small businesses. So how do we actually create a cash flow forecast? Well, the first thing we need to do is look at our business's history. Over the course of 12 months, how much do you bring in from sales? Then adjust that for seasonality. But you'll also have to do some math because you'll need to adjust for the growth that your business will see. Let's look at a simple way of how to do that. Here's a very basic sheet of a totally made up business with some very round numbers for easy math. Now, if we look at this chart, the first thing that you'll see is this business does have some seasonal swings. It's busier in the spring and summer than it is during the winter. The other thing to notice is that its operating expenses are super consistent. This is pretty normal for a solo service business. Now, there's one more thing that you should look at before you make a forecast going into next year. If you look at the numbers of this January versus the past January, you'll notice they're up significantly. The revenue jumped up 22%. Now, we probably shouldn't plan on continuing to have that level of growth, even though it might happen. So let's assume that we continue to grow, but at half the pace that we're currently growing. Most people would look at this and just copy and paste and increase all the numbers by 11% and call it a day. But we're going to do something more accurate. Your business doesn't grow like a set of stairs. It grows like a ramp. We didn't grow 22% between December and January. We grew 22% over the course of 12 months. I know the last thing anyone wants to do is algebra, but here's the equation to find out how much your business is growing if it's compounding each month. You would then take that number and multiply it by however many months out you are, and then multiply that number by that month's revenue. So if we're looking at June of next year, we would take our growth rate of 11% and plug it into our equation. We come out with 0.87%, and June is 5 months from now. So we take our 0.87%, multiply it by 5, and we end up with 4.4%. Add 1 to that number, so you should end up with 1.044, and multiply June's revenue by that number. That will be what we can expect June's revenue to be if we continue to grow at 11% year over year. The reason you do this is because it keeps you from overestimating early months in the year than if you were to just slap 11% on it. Now, we also need to estimate our expenses. Remember, we do need to spend more as our business grows, whether that's on personnel, software, equipment, or something else. Now, depending on the business, instead of forecasting percentages, we might actually look at individual expenses and just add those to our expense column. Now, there is one exception to this: staffing. Staffing expenses are usually growing at more unconventional rates because of cost of living raises, promotions, and other things. So you may want to use some percentage math like we did before. Now we can forecast our net cash flow over the course of a year. Now, here are some mistakes that people make. The first is that they're too optimistic about what's going to happen. Whether that's relying on too much growth, not counting on enough outgoing cash flow or unexpected expenses, or simply not taking into account new information as it becomes available. All of those things are going to skew your numbers in such a way that it's really not helping you plan around your business finances. And if you want to learn about 5 money mistakes that most solo business owners make, you can watch this video here.